Right, let's work under a simple hypothesis. Let's say you get 7 trades out of 10 correct based on the various systems which you might have developed yourself, or the ones we're going to show you in the CD-ROM set. Moving forward then, let's assume you have an average 20% return on the correct trade. Now, I know you said you're only going to enter a trade if you expect a 30% return, and by 30% I mean either it's a long-term purchase where you haven't got any leverage, you're just buying the shares, let's say it's Vodafone, and you expect it to go from 100 pence to 130 pence, or it's a short-term swing trade where you expect, say, Vodafone to go from 100 pence to 110 pence or 115 pence, but you've got some leverage, you've done a spread bet or whatever, so you expect a 30% return on your capital. So if Vodafone goes from 100 to 115, which is a 15 pence rise, the reason you expect a 30% return is because you're not just buying the shares and having a 15% rise, you're actually doing a spread bet or CFD trade, so you're getting a great return. But that's your expectation. Whatever the expectation is, let's just assume that on average, on the trades you get correct, they don't all give a 30% return. They only give an average of 20% return. And that's fair enough. I think it's a fair assumption. I think the 7 out of 10 being correct is a fair assumption. Yeah? Now, assume the maximum is a 25% loss if you're wrong. If you are wrong on a particular trade, you lose 25% of the capital in that trade. So if you put £10,000 in, you lose £2,500 on that particular trade. And I think that's a fair enough assessment. So basically 0.7, which is the probability of being right, times 20%, which is the average gain on correct trades, has to be greater than 0.3, which is the 30% of trades which are wrong, 3 out of 10 which are wrong, and the 25% loss that you incur on them. And it is. If you can do that, you've got a winning formula. Let's go through it again. Pretty straightforward. This is why we look at systems, why we look at charts. 7 out of 10 have got to be correct. Average 20% return on correct trades, whether it's through leverage or longer term investments. Only trade, however, if you expect a 30% return. Maximum loss, 25%. Now, what would cause you to improve or fail in those odds? Well, first of all, if you became undisciplined and so more of your trades were wrong, then this would cause you to lose more money and fail. And if you became undisciplined and you took bigger losses, you would lose. Guess what the two major reasons are why private investors don't make it swing trading? One is they become undisciplined and they allow themselves to take bigger losses. Secondly, they become undisciplined and don't wait for the best probability trades and so have more losing trades. There you go. You can see how mathematically we can put it down on paper as to how you should go about it. Now assume you had a total original capital of £60,000 for argument's sake. You can work out what your value at risk based on that is. Let's just have a look at some of the details. You've got £60,000 total capital. Therefore, let's assume you divide that into 5 equal lots. So you put £12,000 in each individual trade. Following me so far? Remember, if at any point you need to pause, just hit the space bar on the keyboard. Therefore, the risk per trade is 25% is the maximum loss you can have on any individual trade. Remember we said £12,000 is how much you put into a trade. So that's £3,000 is the maximum risk money you could lose on a particular trade. That also happens to be 5% of your original trading capital, which was £60,000. Yep, was 60k. Now remember, ideally we want this figure to be even lower, but we've just taken this particular example. One way to get that figure to be lower is to have more trading capital. If you had £100,000, that figure would be 3% on any particular trade. You can see how you can fiddle around with these figures so you get good set. Now let's say you had a maximum of 4 open positions at any one time. Then the maximum value at risk is 4 positions, £3,000 losses on all of them, let's say. That equals £12,000, 20% of your capital. You would lose 20% of your entire trading capital if all 4 trades which were open went wrong. Similarly, if only 3 were open at any one time, you'd lose 15% of your original capital. So you can see what your value at risk at any one time is, between 20 to 15% of your total capital at any one time, but you'd need 4 wrong trades hitting their maximum worst position. Yeah? Now, what might your annual profit forecast look like? Let's say the expected profit per trade is 0.7, because 7 times out of 10 you're correct. You get a 20% return on each one. You got £12,000 per trade, that's £1,680. Yeah, 0.7 times 0.2 times 12,000 equals £1,680. You've got to subtract from that the losing trades you'll have. 3 times out of 10 you're wrong. You lose 25% of the £12,000 per trade when you are wrong. Remember, it's £12,000 per trade. That equals £900. That doesn't mean you're going to lose £900. This is the expected gain and expected loss. That means you've got £780 net expected gain. Therefore, your net profit margin is 6.5%. Yeah? Because that is worked out on the 780 calculated there. The annual net profit is 780 times, let's say you do 30 trades a year. That's £23,400. That equals a 39% per annum net return on your original capital of £60,000. Now you might say, well, wait a minute, 40%? That's a bit steep. There's a lot of variables. You can tweak this yourself. Maybe you don't have 60k trading capital. You might have less. You might have more. You might assume 12,000. And remember, by the way, the £60,000 trading capital, you might use spread bets or CFDs, so you might only need a quarter of that, because the rest is borrowed on margin. Look at the spread betting CDs if you want to know more about that kind of thing. And similarly, with £12,000 per trade, it might not be £12,000 cash you put down. You might only put down £2,000 cash, but because it's a leveraged or margin trade, it has the buying power of £12,000. So, what might make us not hit our 39% per annum net return on original capital? Why might we fail on that? Well, we might use smaller trading capital. We might have less money per trade. We might not win 7 times out of 10. We might not make 20% per trade. So we've got to be really patient and make sure we do. We might, as I say, have less trading capital. Those are the various reasons. If those reasons don't apply, let's say you are right 7 times out of 10, you do make 20% in those. You are wrong 3 times out of 10, you do lose 25% of those. Then all other things being equal, we should be able to get a 39% per annum net return on original capital. 39%, not bad at all. You can see the maths. You can see how it's done. How might we optimize our profits? Well, as I've said before, you might be able to find more opportunities in different markets. You might have gone through the commodity CD-ROM and thought, well, actually, we want to do more, add to the number of trades per annum by looking in different markets. The probability of successful trades might go from 7 out of 10 to 9 out of 10. To be honest, 7 out of 10, be happy with it. Percentage return for a corrected trade, again, be happy with about 20% returns, pretty good. Personal ability to stop losses, that's something you've got to control. Return per trade, well, that's dependent upon all the other factors. Yeah? What will be one of the key reasons for success? The willingness to hold funds invested awaiting real opportunities is a key to success. If you're wrong, the opportunity will return later. Cash can be comfortably held for a long period. As I said, you can pause this and look at all of this by hitting the spacebar.